Hey guys, welcome back to another video on how to buy your first property. Today, I want to focus particularly on the financing part because I'm actually getting a mortgage set up for a potential investment. Sometimes deals come up where you need to close within 30 days, 15 days. So being fast and being ready is extremely important. If you're able to offer great terms on short closing date, maybe no financing condition, this is how you can make your offer even more attractive to the seller, even if you're not paying top dollar. And that way you can bank a little bit more money in your pockets and wait for that appreciation. You can get a mortgage almost at any financial institution. The big banks obviously do it, credit unions also do it. Sometimes there are also specialized lenders that focus on specific niches in the market. Typically, the first place you will go are banks. They're the ones that are most well known and they are available everywhere. However, the rates that they charge you do reflect that. There is a premium compared against rates that you can get elsewhere. And better rates you can typically unlock by going to a credit union or a specialized lender. Then there are mortgage brokers. Their full-time job is to connect you with a lender. Typically, they try to get the best rates and they're connected. They have access to all the same lenders, and instead of you going to a lender one by one, they already have that network. So you can go to them and they may be able to get you a better rate than you could yourself. The mortgage broker is typically paid for by the lender, so if you see the final rates, it's better coming from the broker, go with them. If you see a better rate on your own, go with who you find. Let's start off with conventional home loans. Conventional home loans is essentially mortgages that lend up to 80% of the property value. What that means is you will need 20% down. There are then insured mortgages, which allow you to go above an 80% loan to value. And what that means is maybe up to 95%. These insured mortgages are otherwise known as high ratio mortgages. 95% allows you to put less money up front so that maybe you're saving up for a down payment, or maybe you want to hold on to cash so that you can use it somewhere else. This is typically only allowed for first-time home buyers. So remember last time we were talking about buying a duplex, triplex? This is actually a perfect opportunity because if you house hack and you live in one unit, that actually qualifies you for an insured mortgage. And that allows you to put down as little as 5% down. The drawback to that, though, is that you will have a higher monthly mortgage cost to you because you're ultimately borrowing more money. When you go for insured mortgage, typically the rates are lower, typically by 0.3% is roughly the spread that I am seeing right now. However, depending on where you are, amortization could be capped. As in, instead of a 30-year mortgage, maybe you have to look at a 25-year mortgage. You have to look into those considerations to make sure you are okay with what the monthly payment will look like. And remember, with interest rates right now, buying a property will barely cash flow with prices where they are and rent where they are. The challenge with mortgages is that typically you make some cash flow when you are 80% down. When you get up to the 95% down, it's very hard for single-family properties for them to cash flow. So then you really have to focus on what are the multiplexes, what are the apartment buildings that you can buy into your real estate portfolio that will allow you to capitalize on these insured mortgages. Then there are other types of mortgages, more specialized ones. For example, instead of buying to rent, maybe you want to buy to flip because that's where you make money extremely quickly if you do it right. And in those situations, a flip loan or a construction loan, those are the types of financing that will carry a higher interest rate, but it will allow you to close out the mortgage anytime. So there is no penalties within 6 months, 12 months for you to exit. Remember, when you lock into a mortgage, oftentimes whenever you get into mortgages, the terms for termination are actually quite punitive because banks, once they lock in that loan, they don't want to let you go. So just be careful of what the terms, what the conditions, and what type of loan you're getting. And I want to squeeze in here that you need to get a pre-approval. If you are shopping for a property, if you are looking to invest, make sure you go to a broker or a financial institution to make sure that you can line up for financing. They can tell you what the rate you qualify for, and they can typically hold it for 3 to 4 months. And they'll also let you know how much you qualify for based off of your income, based off of your ratios. How much you qualify for will be dependent on 2 main ratios: your debt to income and your total debt service ratio. Those two are essentially calculations to make sure that your monthly income is sufficient to cover all of your liabilities and that the banks don't have a risk. A lot of the work that goes into getting the mortgage actually is also done when you go for a pre-approval. What that means is you should get ahead of that process. Get the pre-approval so that you're ready when you're submitting an offer. You can go in knowing full well that first, you can go into an offer knowing full well once the agreement is signed, you have financing secured, so that you don't have to scramble to secure a lender, secure financing after the deal has been signed. Second is, if you want to, and be careful about this, you can even submit an offer without financing conditions to make your deal more attractive to the seller. Maybe you can even squeeze a price concession out of them. When you go in for a pre-approval or when you go in for the actual mortgage, here are some things that you need to have ready and on hand to make the process as smooth as possible. They will ask for documentation. For example, your tax filing from the last 3 years, your employment letter, your last 2 pay stubs, plus if you receive any commissions or bonuses, they will ask for a statement for that as well. They will ask for any assets that you have, what the liabilities are, if you have lines of credit, credit card debt, other mortgages, car loans, leases. Think of anything else that constitute monthly payments like rents. They will also consider what are your current living expenses. If you will not be living in the property and you're purchasing this as an investment, they will count all the utilities that you are accountable for, all of the taxes and mortgage that you're accountable for. And depending on where you are, sometimes the financial institution will take a portion of the rent, typically 50 to 80%, depending on what city you are, and factor that into your income, which will help you qualify for a little bit more than buying a place outright to live in. They'll also look for the MLS listing of the property, just to get all the details, get the rundown of the property. They will then ask for a status certificate, if that's applicable, typically for condos. They will look for government ID as well. They will also ask for last 3 months worth of bank statements. They want to understand your source of down payment, whether that's existing cash you have sitting in your checking or savings account. It could be from your investments. Liquid can be sold. They're not telling you to sell yet, although eventually you may have to. However, this excludes anything that is locked behind vesting period or that it is not liquid and easily accessible by you. When they add all that up, it should equal the down payment plus closing costs. And remember, closing costs can run up to 3% of your purchase price, depending on your jurisdiction, sometimes land transfer tax. That is usually the largest amount. You have other things like legal fees, which is a couple of $1,000s, as well as a percentage of your property. So always keep in mind to set aside extra money when you're budgeting to purchase your property. The good news is that whenever you go through pre-approval, you will actually go through all of this math up front. So there you have it. There's a crash course on purchasing your first property and a crash course on financing. I'll see you around. Remember to like and subscribe and stay tuned for the next video on how to buy your first property.